Gold is the Rosetta Stone of the financial world.
We're taking our monthly look at all things technical analysis, and I'm joined again by Patrick Karim from NorthStarBadCharts.com, and we're going to be talking all things gold. Patrick, welcome back to the channel.
Hi, Dave. It's been fun. Already 3 months, I think. It's bonkers how the time flies by there.
Indeed. Yeah. This is, I think, is our third chat with you this year. I have a question for you. Seeing as we're past the halfway point now in 2023, give me an idea. What are the big picture things when it comes to the charts for gold? Why should people be keeping a close eye on gold at this moment in time? And what are your expectations now for the future?
Well, first, I'll pop the bubble. There's like no confirmed breakout on the semestrial close or on the quarterly close. I could probably show you guys a chart. But the good point is the coiling is insane. And the chart that's coiled for quarter after quarter after quarter, and you'll see it like we know everybody's looking at the daily chart and there's pullbacks and a whole bunch of stuff. When I'll show you the quarterly or even the semestral chart, those are 6 months candles for gold. It's like we broke out in June of 2019. We went all the way to those all-time highs, and it's been a straight line sideways. So that's, how could I say it? Like, people always say, oh, Patrick, you look at the bullish picture. Well, look, you're close to the finish line. Of course, you're going to look forward. I'm not saying we won the race, but I'm saying we're closer to winning the race. That means like getting a breakout and having a sustained move upwards than we are to breaking down. It's like, for me, like, I'm not going to think about a breakdown until, well, of course, that we have like bigger roadmaps where gold can break down, but we're not there yet. Like, until gold starts breaking down technical levels where, okay, it's below 1800 on a semestral close, etc. Of course, then it could start carving out downtrend. But right now, we got to keep an eye on gold because gold is the leader of all this stuff. Gold broke out in 2019. CPI was breaking down, going nowhere. Gold peaked way before CPI broke out. And when all the masses, oh, CPI, it's at 8%, whatever, it peaked in, forget what, in 2021, gold had already topped pricing in that rise up. So forget the CPI ratings, forget all. Gold is the Rosetta Stone of the financial world. It's going to sniff out the destruction of purchasing power, and I could show you a chart also for that ahead of time before we all us talking heads, we start talking about it. And you know, remember when inflation was 8-10%, everybody was looking at 20%, like right away, you know. And unfortunately, most of the time when we talk about something, and we have these crazy targets, it's the end of the road, you know, at least on that time frame. Doesn't mean those targets can't get reached, but
so indeed, yeah, pull up a chart first there.
yes.
As you're saying, probabilities are more weighted towards a breakout to the upside than a breakdown at this stage. You talk about this concept, as you call it, coiling. Maybe you can just explain, when you put up this chart, explain what you mean by coiling. Where can we see it? What is it? What is it? And what does it mean for the future of the gold price?
All right. Okay, I'll just zoom in. Here is the semestral close for gold. I'll zoom in really close, really close. So here was a breakout on a semestral close back in H1. So semestrals, I think we use the H1, H2. I don't know how you guys do it in your neck of the woods. So here was like the most beautiful clear signals right here. It shot up, and now it's happening. I'll put another line here, and I'll put another one here, and I'll zoom in. This breakout, pull, flag, look at that. Look how tight it is. And these wicks, that's noise from the quarterly chart, from the monthly chart, from daily chart. Look, I'll put it in the daily just to show you. Reset chart. Look at all that. Look at all that. That's all that price action I showed you here.
Sure.
On the look here. Oh, it's the end of the world. Harry Dent coming out of the woodwork saying we're going to $600 gold or 900. Or if it's up here, then we're hearing about Peter Schiff telling us it's about to go to 5,000, right? If you zoom out, and let's go back here, it's just a beautiful pull flag right here. And if that closes here, look, we didn't have it. I thought like the last time we talked, maybe we get that a quarterly close, semestral and quarterly close above this. Look, I'll show you the quarterly. The quarterly also is pretty coiled, not as much, but it's still building out a a megaphone pattern on top. So if ever you get a close above that line, that also is very bullish. So we gotta wait for that close for that close above, a convincing close above 1900. If we want to give numbers to people, yeah, 1914. So I'd say convincing close. That means maybe a close 1950, 1980. It has to be convincing, just like I showed you here back in June of 2019. I could have shown you that chart, and even if you're a neophyte chart trader, and we're back here, forget all this. Where can I here? I'll remove all that noise. I'm there. Let's say we're back here. It's June 30th. Me and you were talking in July, and I say, Dave, this is it. This is it. We're breaking out. And you're gonna say, well, explain to me, Patrick, why we're breaking out. Well, I'm gonna tell you, we have a 8-year base. 2013 to 2019, a 6-year base. Look at all these wicks, noise, clean breakout. This was the time to go long, and it's convincing. You see, there's no upper wick where sellers come in.
Yeah, it's very visually immediate chart, isn't it? You know what you're looking at.
Jesus.
You know what you're looking at there. It's quite obvious the strong breakout there. And when we take out the noise, as you say, all the machinations and movements on a short-term basis, when we take those out, we're looking at, you know, the quarterly close and the semestral close, and it gives a much clearer picture in terms of confirming whether we've got a strong breakout and a potential bull market to follow.
Yes. So this is where it gets tricky now. Gold has to, while nominally it could go up and break out on its own chart, for a full-fledged bull era in precious metals, you need gold to break out versus SPX. So here is the semestral close, the semestral chart for, so here it was in the 1960s, gold's putting in the bottom versus SPX. Well, of course, this is primarily the SPX going down because gold was pegged. So here it goes. Here's the 2000s bottom, pull, flag, just like today a little bit, like on the gold chart. Pull, flag, a semestral close. Look how convincing it is. Again, guys, look at that. That's what I'm looking for gold. That's why I'm not jumping if it breaks. Somebody says a breakout on the daily chart. Like, I don't care about that. I'm looking for this because this means I'm going to have tailwinds for a longer period of time because it's a semestral defined breakout. I know that those pullbacks here, even here, this would have looked terrible here in the on the daily charts, but you know you have the tailwinds because of that convincing breakout, and then goes. So that's what I'm looking for here. Look, there's nothing convincing here yet. I don't know where it's going to be. At least this level. Look, until gold, I think we talked about gold being worth half of the SPX. It has to at least get convincing close above here, above
what level's that?
And eventually the real full-fledged is probably going to be a little higher here at 2/3. When the gold is worth 2/3 of the SPX, then we're going to have some crazy moves. So it doesn't mean gold can't go higher, because both, by the time this happens and this, by the time this happens, gold, it could be at 3,000 here, right? It's all a ratio chart. Because imagine if it's 2/3 of the SPX, let's say SPX is at 6,000. What's gold going to be at by the time this? It's going to be at 4,000, right?
Yeah. But what you're seeing is, when you're seeing a breakout versus the SPX, what you're seeing is you're seeing a rotation out of the SPX and into gold. That's what you're saying. And you're saying that's when you're going to really see this thing take off, because there's going to be a lot of money coming out of the SPX and looking for a home in it. And then if you couple that then with your quarterly close and your semestral close, these are some kind of great combination of indicators. You might see a breakout in the quarterly close. First of all, you'll see it probably in the quarterly close before you see it in the semestral close, as it always generally is. And that's a good signal for a breakout. And then you're saying that's great confirmation if we see a breakout versus the SPX, and it's going to potentially signal a stronger bull run in gold, as there's rotation out of the SPX and into gold.
That's right. And not only gold opens the floodgates for silver. Because look here, I just put the silver chart. Silver tracks, and I'll show you exactly. I found out there's even a better macro driver for silver. Silver tracks, at the very least, the capital flow. See how silver's putting a bottom here, and as the
Sure.
capital flows are going to gold, silver tracks that.
Good correlation there for a lot of that,
Yes.
chart. Yeah.
Well, if I could digress, I'll show you one chart that's really should enlighten everybody to what CPIA. Gold divided by CPI. Reset chart. Look at the silver chart overlaid on top of that. It's even more apparent that, because everybody says, oh, gold, this is gold. It's not even above. Here it's all-time highs in 1980. Well, here's a peak on the smaller time frames. Gold is not the inflation-adjusted version of gold is the better play that silver is. So whenever people say, oh, silver, it's not a 1980s high, look, silver depends on the outperformance of gold of CPI.
Okay.
And that's even more apparent. So this is the way I say it. There's always, CPI always goes up practically, right? Unless there's like some type of deflation event, and like CPI always goes up. It's how fast it goes up. So the next time we have gold's going to break out before CPI bottoms, or when CPI bottoms, gold, if it sniffs out that CPI is going to go up, is going to start breaking out. So gold's going to break out. CPI is going to track as long as gold, for the ratio of gold to CPI to go up, but it doesn't have to be this way, but most of the time it's because gold is going up, CPI is going up, but gold is going up faster than CPI. It's pricing in the trend of the CPI going up, and then gold's going to peak, CPI is going to keep going up, and that ratio is going to start turning down. That's when silver turns down. So you want gold to go up, you want CPI to go up, but you want gold to outperform CPI, and that's the best landscape you could have for silver. Because look at that chart. It's like, holy Moses, like it's waiting for that. It's waiting for that breakout for gold to break out versus CPI.
Sure. And it just shows the inflation hedge the gold is.
Yes. It's gold tracks your purchasing power to it's like, I'll do the DXY. I've done this chart. Like, so the DXY, everybody says, oh, gold tracks, protects your purchasing power. Oh, look, well, let's head over to Twitter, because I did these super recently. Here is everybody telling me, Patrick, here's this chart. Everybody, oh, the DXY, the US dollar, gold's inversely correlated to the US dollar. It's critical that the US dollar goes down. And then I'm telling people, look, there's no correlation. So on any given chart, okay, I'll rephrase that. Not that there's not any correlation, but it's not the most meaningful correlation. So on any trading view chart, you could go and pop in a correlation coefficient. So essentially it's telling you the price of your instrument. So here's gold. So this is tracking gold. I popped in DXY, and it's telling me what's the correlation of the price movements of gold with that instrument. And here I'm on the quarterly. I had to zoom out a lot. So on the quarterly chart, and anything above 0.70 is statistically significant correlation. Here is the correlation with the DXY. So the DXY, for people who don't know it, it's 68% or 65%. It's essentially the euro. So it's the USD euro pair, right? So that's really very important to know. So look, okay, here's correlation, the 70s, 80s here. At 0, that means there's no correlation. And the -1, it means it's inverse correlation. I flipped here the scale for people who are like really DC -1, but I actually inverted the scale because I wanted to show positive correlation on top. And look at this. Since the last time we had a statistically significant correlation with the DXY was back in 2009, 10, 11. And since then, here, okay, here it picked up, but here we're at negative, or there's barely no correlation on the hard times with DXY. So if you DXY divided by PPI, that is your purchasing power. That's the inflation adjusted using the producer price index as a proxy, DXY. So the US dollar strength versus the euro, adjust that for inflation, and look how much the correlation is look, see, don't have this huge drawdown like in 92. Look how it stays up. Here, yes, it lost a lot, but it gained faster. So even if there's US dollar strength, if there's more inflation, the DXY adjusted for inflation that chart is gonna keep going down, and gold tracks that. Look, way better. And even here, look, we've had a drawdown, but that correlation adjusted for inflation of the DXY, it's already almost statistically significant, while just the DXY. So this is telling me people are scared of the milkshake theory. I don't know if you heard about that, but
indeed, yes.
Yeah, it's like super famous, but whatever you want to call it, let's say a bull run in DXY or the US dollar versus the euro, that could happen. Gold could still rocket as long as there's more inflation. So as long as the DXY, the ratio of DXY versus inflation goes down, even if the DXY shoots up, but there's more inflation, gold's going to go bonkers, silver's going to go bonkers, etc. There's no fear. People have to stop fearing the boogeyman that is the DXY. Because in the 2000s, the gold, people remember this, is gold primarily went up, not because inflation was going crazy in the 2000s, primarily because of the US dollar was going down. So the DXY adjusted for inflation can also go down with inflation staying flat, but the DXY losing strength versus the euro, right? So
Indeed.
that loss of purchasing power will also make, but people are looking just at the 2000s. You got to look now at what happened in the 70s. I could show you one more chart, unless you want to
Sure, go. Please do. Please do. This is fascinating
ask me a
stuff.
tough question there. To just back it up. I could have done this a better way. Okay, I'll do it a better way. It's called interest rate payments. Recently, everybody's going bonkers because they look at the interest payment chart for the federal government, right? There, how much money? Everybody sees this and they say, "Oh, it's unsustainable. It's the end of the world." Well, first thing I do is I check the rate of change for that thing. Here, I'll just hide these, make this cleaner. So while the interest payments they're exploding upwards, reset chart, the 10-year rate of change, this is telling you how fast it's moving. I could even add more of these. Copy. I'll add a few more here. I'll put the 7-year rate of change. I'll put the 4-year rate of change. So those rates of change are telling me what's the momentum change. And the market, that's what it prices in. It's not that something keeps going up and up and up, and that something has to, like, other correlated assets go up and up. It's how fast that thing's moving. That's what the market reacts to. And look at all these rates of change: the 4-year, the 7-year, the 10-year. It went up in the 70s. We all know what happened to gold, silver, oil in the 70s. Look at that, where it peaked. 80, 82 started turning over. So as the government interest payments, they keep going up, but they're going up less fast. That was a bull era for growth stock, etc. Bottom, look where we are today, breaking out at an angle. All three of those time frames, those rates of change, are breaking out practically at the same angle. Look at this. This is bonkers. I'll put an angle
vertical
here. 68 degrees. Look, we're in the 1970s there.
Yeah.
It's never been like that since the 1970s. And here, I'll show you another one. Here is the performance of the interest payments. Look, I put interest payments. Some people say, Patrick, why are you doing that? I could have put the producer price index. It's exactly the same chart. Exactly. I'll put logarithmically. Look at that. It's the same chart. So producer price index going up, interest payments are going up. Why are interest payments going up? It's a combination of either more debt or higher rates, right? But those things, they create the destruction of purchasing power, which you could see in the producer price index. It's all this stuff is linked. So if the producer price index is breaking out versus SPX, or the federal interest payment expenditures are breaking out versus SPX, then you're in a new dynamic where, just like you're in the 70s right here, just like it happened in the 70s, a breakout, you're outperforming growth stocks. So the debt burden, the payments, the inflation, markets have to reposition themselves in asset classes which are going to protect them against something that's outperforming the SPX, because people are going to see that, say, I'm getting better returns in the producer price stuff, commodities, etc. They're going to start piling on in there because the growth stocks aren't performing as well.
So this is a good chart to look at in terms of trying to assess whether you're close to having a breakout in the SPX versus gold as well. Then,
yes,
and that whole idea of rotation. So kind of nicely links all of those together.
yes. Look, here's the 2000 to 2011, the crazy bull run for gold breaking out versus SPX there. It was just a bear market rally within this 40-year downtrend. It was just that small move up to tag that breakout line. Just that brought gold from 250 all the way to like 1900. So imagine when this line's gonna break, it's gonna be bonkers. And you see the yields like are relentless. The yields, the 10-year yields are just bonkers. TNX. Look at this thing there. It's like remove drawings, move drawings, move indicators. Look at that. It's like Jesus.
Yeah.
Like all these charts are they're all the same. Look, a pull flag. It's trying to break out. It's like it's a paradigm shift.
Yeah, you don't need an arrow to see the rate of change there. You know,
Yeah, this thing's just bonkers. It's just through the roof.
It's dramatic. It's dramatic.
Look, this could happen for sure. But now we're dealing with higher lows. You know, it's the Fed fund rate could go down to zero, try to drag down the 10-year yields, but they're gonna have a hard time having this. They're gonna have a hard time to bring that thing back in the in that 40-year channel there that broke out there. They're gonna have a hard time doing that there.
The genie is truly out of the bottle here, isn't it, Patrick?
Look, yeah, it is. If you zoom out and you see these charts, definitely it's out of the bottle. And if ever the genie goes back in, well, we'll deal with that. We'll go along whatever best performing assets are out there. But right now, like the tailwinds are definitely in favor of gold, silver, oil, uranium. Like insert that. The miners, well, miners suck. They've always sucked. It's like gold's a big daddy. Gold's a surest bet. Silver is also the surest bet because, like you saw, silver is going to track gold's performance versus CPIs, but miners, they're coin tosses. These things, you know, they're 100% coin tosses. Like unless you go in an index, but overall, over long periods of time, if you divide the ASA chart, the precious metals fund, with gold and silver miners divided by gold, they've performed terribly since ever. It's like it's like clickbait. People are clickbaiting those miners like, oh, went up 10,000%. Yeah, but Jesus, it's like you have to time it to perfection. Just own gold, for crying out loud, or buy futures or options on gold. It'll be way more safer. Leverage the opportunity. I'm not a financial advisor, but I would definitely leverage using margin on gold way before I buy miners. Look, they're just terrible. Sorry.
Listen, as ever, Patrick, you've given us plenty to think about. I really appreciate you coming back on. NorthStarBadCharts.com is your website. I encourage everybody to get onto that website, sign up for Patrick's stuff. As you can see, he has a different way of looking at the markets. Very, very interesting, very skilled. It's always a pleasure to have you on, Patrick. Thank you very much.
It's an honor, Dave. Thanks.